Looking for a Monday trade setup? I got a great one for you. ARM Holdings, ARM. ARM doesn't just make chips. They are a royalty machine. Think of it like a toll booth on billions of chips across phones, PCs, cars, and servers. Their footprint is huge. About 99% of smartphones run ARM-based processors, and partners have shipped hundreds of billions of ARM-based chips. Let's check it out. I'm going to show you on my platform, Thinkorswim, exactly the kind of trade that you can use right now. Let's jump right in. Now, ARM dropped over 9% on Friday. That is the best time to sell a put after the price goes down. Check it out. If you don't know what a put is, let me explain it to you. What you're doing is you're promising to buy shares if the price goes down. If it doesn't go down, you don't buy the shares, but either way, you keep the premium that you're paid, and you're paid right then and there when you make the trade. It's so much better than buying stock. When you buy stock, you're just like hoping and praying that the price goes up so you can sell your shares and make money. No, with options, you make money right away. Let's take a look at some ideas. So ARM right now is trading at 154.81 per share. So you can sell a put and you can choose what price you want to buy the stock if the price drops below that price, right? Let's take a look at our strikes in the middle of the page here. And let's say we want to be super conservative because ARM is an aggressive stock. It has a lot of volatility. In fact, ARM is owned almost 90% by SoftBank. And SoftBank right now is using their shares as collateral. They're trying to get $5 billion more in funding for some really big AI plays. Now, I like volatility because volatility means if it goes down and you have to buy the shares, when a stock is volatile, it already has all those ups and downs. You could just sell a covered call against it and make money then too. So let's say we want to start out super conservative. We can sell a 145 put that expires on Friday. So we're only going to hold the trade for about a week. I don't like to tie up my capital for that long. This particular contract closed Friday at $251. So what that means, guys, is you get $251 dropped into your bank account right when you make the trade. And what you're doing is you're committing to buy 100 shares of ARM, but only if the price drops below 145 before it expires on October 17th. If it doesn't drop, you don't buy the shares. Either way, you keep the $251. How's that for a deal? Now let's calculate the rate of return if we were to make that trade. If we're collecting $251 in premium, we're going to divide that number by the amount of capital we have to put up to make the trade, which would be 14,500. That gives us a rate of return of about 1.7%. But remember, guys, that's only for 1 week. So if we were to annualize that out to try to get an idea of how much money we can make on an annualized basis, if we did a trade like this every single week, we'd be making about 90% on our money. And guess what? This particular contract only has a 25 delta. What that means to you is that there's only a 25% likelihood that ARM is going to drop below 145. Remember, it already dropped 9% on Friday, and it's trading at 100, almost $155. So it would have to go down another $10 before Friday for you to have to buy those shares. Let's take a look at a closer to the money. Let's say you really like ARM and you don't mind buying the shares if you had to. Let's look at a 152.50 put. That closed at $535 on Friday. So let's take a look and see what the annualized rate of return would be on that trade. We're going to divide $535, our premium, divided by $15,250, and that gives us a rate of return of about 3.5%. Now we're making 3.5% on our money. And if the price stays lower and goes down and we have to buy those shares, you can turn right around and sell a covered call against it. Let's look at the covered calls. And here's another idea that you can use Monday when the market opens. Let's say you like this particular stock and you just want to straight out buy 100 shares. You would buy them at the market, and right now it's trading at 154.81. So you're going to put up about $15,500 approximately. Now, when I own shares, I like to sell an at the money call. What that means is I'm taking in as much premium as possible, and I'm committing to sell my shares if the price goes above what I paid for it. So, for example, you can sell a 155 call also expiring on Friday, and that closed at $650. That means that $650 gets dropped into your bank account right when you make the trade. And what you're promising is that if ARM shares trade over 155, you're going to sell your shares at 155, which is okay because you only paid 154 and change. You keep the 650 no matter what happens. So let's say ARM price goes down or it stays flat. You keep your shares and then you sell another call next week. Now, here's why I like ARM. Because SoftBank owns about 87% of ARM, and ARM is this powerhouse, this toll booth of chips, and they're putting their shares up as collateral for this gigantic $5 billion loan, it gives me a little bit of confidence that even though the stock is volatile, I'm pretty sure it's not going to go bankrupt. Obviously, you'd have to do your own due diligence. I'm not recommending this stock. I'm just giving you different ideas that you can take action on right away. And let's say you don't even want to put up all the money to buy 100 shares. You can use some of the bank's money. You can use what's called margin. So you would only have to put up maybe about 30% of what the shares would cost you. So let's calculate that. If you were to use margin, how much money you'd have to put up. If you're buying the shares at 154.81 and you're buying 100 shares and you only need to put up a 30% deposit and use the rest of the money from the bank, you'd need about $4,600, a little bit less than $5,000. And for this particular trade, you'd be making $650. So you're putting up 4,700. I'm going to round that off. You're putting up 4,700 and you're making 650 right off the bat. And that's guaranteed income, by the way. You keep that premium when you sell a call, no matter what happens. So let's see what our rate of return is. I'm making $650 in premium. I'm putting up $4,644 in capital. Now I'm making almost 14% on my money for 1 week. Now, this trade isn't for everybody because it is a volatile stock, right? The implied volatility, in fact, the implied volatility on this particular contract is almost 90%. So it has a lot of swing. But if you have a healthy risk appetite, this might fit very well inside of your portfolio. Anyway, I hope this trade idea helps. Be sure to subscribe to my channel. I'm putting up a new video each and every single day, walking through different stock trades just like this one, talking all about selling puts, selling covered calls, how margin works. Drop a comment in the video. What's your favorite ticker? And if you want to join my inner circle, I'm always sending out tips and tricks to people in there. I have the link in the comments below. Happy trading.